Hello students, today we will continue with the chapter income from house property. So house property held as a SIT. SIT means stock in trade. So what treatment should be given in the case if house property is held as a stock in trade? So if house property constitutes stock in trade of a business, rental income from such house property is to be taxed under the head income from house property. Since specific head has been given for income from house property, it cannot be taxed under any other head. Means if you are treating house property constitute stock in trade of a business, then in that case whatever income, rental income that is generating from it is taxable under the head income from house property. So here there is one special rule: house property held as SIT, annual value. How to calculate annual value? It is nil for 2 years from the end of financial year in which completion certificate is obtained from the competent authority if such property is not let out during such period. Section 23 subsection 5 means if it is not let out property during such period, then after getting the completion certificate up to 2 years, its annual value will be considered as nil. After that, you have to find out the annual value, gross annual value, notional annual value, and you have to pay tax on it. So here, rental income earned by assessee engaged in the business of letting out of the properties on rent would be taxable as a business income. But here you have to remember, if he is letting out of the property is his business, in that case whatever income he is getting in the form of rent would be taxable under the head business income, that is PGBP. So this is the two different point. In first point it is very clearly said that if house property constitutes stock in trade, means he want to sell this house property after the construction of the property gets completed. In that case, whatever rental income he is getting, it will be treated as income from house property, and its net annual value will be considered as nil up to 2 years. After that you have to find out DLO, that means deemed to be let out property, and you have to consider that property as a deemed to be let out property, and you have to pay tax on it. But letting out of the property is the business of that person, then whatever rental income that he is getting is taxable under the head PGBP. Now write a note on letting out of building which is supplementary to the business. If it is supplementary to the business, in that case what treatment you will give? If assessee has let out any house property for any purpose which is supplementary to his business, in such case, rental income from such house property shall be taxable under the head PGBP. Simple. Because it is supplementary to the business. Means whatever rental income, supplementary means it is along with it, renting out of a building is his business. In that case, whatever rental income he is getting is taxable under the head PGBP. All expenses of such house property will be allowed as a deduction under the head PGBP. And this is very important. If you are treating rental income as a income of PGBP, so whatever expenditure you have incurred to generate that income is considered as admissible expenses, and all expenses are allowed as a deduction that you have to keep. Because in house property all expenses are not allowed as a deduction, because there is a one standard deduction which is available that we will discuss in coming points. And here one clear cut example is given. If a public school has let out a part of its building to a bank, means what he is doing, he is letting out part of the building to a bank. In this case, rent received shall be considered to be a income under the head PGBP, and all expenses of such house property shall be debited to the profit and loss account. So whatever rental income that school is receiving is to be returned credit side of the profit and loss account, and whatever expenses incurred for that house property will be recorded on the debit side of the profit and loss account. So this is the simple step. So when you have to treat as a PGBP income and when you have to treat rental income as a house property income, that difference is given here. Now next, two steps to compute income from house property. So how to calculate income from house property? So these are the simple steps that you have to keep in mind while you are calculating income from house property. So number one step, first of all you have to find out gross annual value of the property. From that you have to deduct municipality municipal tax. Here two three words are very important: paid by the owner during the previous year, then only it is deductible. Means three words are very important. First one, first you have to find out gross annual value, and how to find out gross annual value, that we will learn in few minutes. But before that we will understand what we have to deduct from gross annual value. From gross annual value you have to deduct municipal tax. But municipal tax is deductible only if three conditions are satisfied. First one, it must be paid. Second one, it must be paid during the previous year. And third one, an important one, it must be paid by owner of the house. Then only it is deductible. So when it is not deductible, so when municipal tax is payable, not deductible. If municipal tax is paid by tenant, not deductible. If municipal tax is not paid during the previous year, not deductible. So that you have to keep in mind. So from GAV, if you deduct municipal tax, you will get NAV, that is net annual value, A minus B. From net annual value, you have to deduct deduction under section 24. Deduction under section 24. In that you will get two deduction, section 24A and section 24B. Section 24A is for standard deduction 30% of NAV, and second one interest on borrowed capital. And standard deduction means it is a fix, means this is a fixed deduction, so that is why no other deduction is available in case of income from house property, because government is giving you 30% of NAV. And interest on borrowed capital means to purchase that house, whatever loan you have taken, and on that loan whatever interest you are paying, that is allowed as a deduction. So we will learn these all steps one by one, and finally after deducting these all things you will get income from house property. So first of all our target is to learn how to find out gross annual value. So determination of gross annual value, section 23. So this is the first important point, how to decide your gross annual value. For that, first of all calculate expected rent. Now you have to first of all focus on this word and remember the acronym ER. Expected rent means ER. How to find out ER? Higher of MV or FR but subject to SR. What does it mean? Higher of municipal valuation or fair rent but subject to SR. This is municipal valuation, this is fair rent but subject to maximum of SR. So if you want to find out expected rent of the property, expected means notional rent of the property, then how to find out that national rent? So there are certain steps that you have to follow. First of all, you have to make comparison between MV or FR. MV means municipal valuation, FR means fair rent. Now, from let us say municipal valuation is 5 lakh, fair rent is 6 lakh. Now, from these two figure, you have to take which one is higher. The higher amount you have to take as your answer. So, higher is 6 lakh. Now, that will become your first answer. Now you have to compare with SR. SR means standard rent under Rent Control Act. Let us say if it is 7 lakh. Now what is the step? Actually rule is MV or FR, whichever is higher, but subject to SR. That means what? Your answer cannot exceed SR. So now you have to compare with SR. So your 6 lakh you have to compare with 7 lakh. So your answer should not be more than SR. So now from these two value, that is 6 lakh and 7 lakh, you have to take lower amount, whichever is lower. So ultimately, what is the expected rent of this house is 6 lakh. So this is the first situation in which your expected rent is 6 lakh. So this is the way you will find out. Now let us discuss another situation. In that, now assume that your municipal valuation of the house is 5 lakh, fair rent is 4 lakh. Now from these two value, again you have to take higher value, whichever is higher. So your answer is 5 lakh. Now you have to make comparison with SR. Let us say SR is 3,50,000. Now, in this case, what is the rule? Your answer cannot be more than SR. So now from these two value, you have to take whichever is lower. So from these two value, lower answer is 3,50,000. So here your expected rent is 3,50,000. So this is the way by which you can find out your first step answer. Expected rent is equal to MV or FR, whichever is higher but subject to SR. Now if you find out expected rent, then next step you have to find out ARR, annual rent received. Now annual rent received means rent received or receivable, and from that you have to deduct unrealized rent. Now let us say what is your rent received or receivable means if it is 1 lakh and unrealized rent is 20,000. Now in this case, what is the answer? 80,000 is your answer. So now you have to compare. If you want to find out GAV means higher of ER or ARR. So your ER is 3,50,000 in the case that we had discussed earlier, or 80,000, whichever is higher. So answer is 3,50,000 is the higher value. So that will become your JV answer. Now one more case we will discuss here. So you will get complete understanding how to find out GAV. Let us say MV, FR, SR. MV or MV is 5 lakh. SR, FR is 7 lakh. Now SR is 6 lakh. So think on yourself which will be the what is the answer. What is ER? Think for some time here. So now the answer is you have to find out in this way. You have to make comparison between these two value, MV and FR, whichever is higher. So higher amount is 7 lakh. So 7 lakh, that will become your first answer. Now next one, you have to make comparison with SR. So your SR is 6 lakh and your first answer is 7 lakh. Now you have to take whichever is lower. So now lower amount is SR. So your answer of ER is 6 lakh. Now let us say annual rent received is 7 lakh. and unrealized rent, let us assume that unrealized rent is 50,000. So what is the answer? 6 lakh 50,000 is the answer. Now again, from these two answer, if you want to find out GAV, GAV, you have to take higher of ER or ARR. So here higher is ER or ARR. So higher is ARR. So your answer is 6 lakh 50,000. So by this simple steps, you can find out the answer. Now, unrealized rent means what? House was let out, but rent could not be recovered from tenant. That is called unrealized rent. But house was let out means house was given on a let out basis, but rent somehow rent has not been collected from tenant and tenant has not paid the rent. So that will become unrealized rent. And vacancy loss, there is one another word. Vacancy loss means what? Loss of rent because house property remained vacant during such period. That means these are two different things. In unrealized rent, house was let out, but tenant has not paid the rent. But vacancy loss means what? House remains vacant, and that is why rent was not received. So that is why this is the two different thing. In first one, house was let out and rent is not paid by tenant. In second one, house remained vacant, and so that is why uh, rent was not collected. So that small question can come from in the examination: when unrealized rent shall be deducted from rent received or receivable. It can be asked for 2.5 marks. So if these four conditions are satisfied, then unrealized rent could be deducted. First one, tenancy is bona fide, means there is a legal tenancy between owner and tenant. Defaulting tenant has vacated or steps have been taken to compel him to vacate the property, means the person who is not paying rent, that is defaulting tenant, has vacated or steps have been taken to compel him to vacate the property, means the person has taken all the steps to vacate the property. Then third one, defaulting tenant is not in the occupation of any other property of the assessee. Means if he is not in the occupation of any other property of the assessee, then also this can be considered as unrealized rent. And assessee has taken all the reasonable steps to institute legal proceedings for the recovery of the unpaid rent, or satisfies assessing officer that legal proceeding would be useless. If these four conditions are satisfied, then that rent can be considered as unrealized rent. Once again, I am repeating all the conditions. If tenancy is bona fide, means there is a legal agreement, tenancy agreement between owner and tenant. And second one, defaulting tenant is now not staying in your house. That means he has vacated the property, or all the steps have been inserted against him to vacate the property. Third one, defaulting tenant is now not in occupation of any other property of the owner. And fourth one, assessee has taken all the legal step for the recovery of the rent, or he can also persuade assist, assessing officer that legal proceeding is useless against that person. If these four steps are, or four conditions are satisfied, you can say that it is unrealized rent, and then it is deducted from ARR, actual rent received. So very simple step. So what are the four steps or three steps to find out GAV? First of all, you have to find out expected rent. How to find out expected rent? MV or FR, whichever is higher, but subject to SR. Then second step, find out actual rent received or receivable minus unrealized rent. And what is the difference between unrealized rent and vacancy loss? Unrealized rent means the house was let out, but tenant has not paid the rent. And vacancy loss means house was not let out and some house remains vacant for some period of during the year, so that is called loss because of vacancy. Now there are different situations. Note, income tax return permit deduction of unrealized rent from GAV. In this view is taken, unrealized rent should be deducted only after computing GAV. So when you calculate GAV, then only you have to deduct unrealized rent. So this is the two difference. Now Jaisri owns 5 houses in Chennai, all of which are let out. Compute GAV of each house. That means all houses are let out. In all cases, you have to find out GAV. Particulars: house 1, house 2, house 3, house 4, and house 5. Now you have to give the answer for this question. Now very simple: municipal valuation, fair rent, and standard rent. So we will highlight the portion which is highest. Like in this case, municipal valuation and fair rent. So which one is higher? So fair rent. But now you have to compare it with SR. It should not be more than SR. But here SR is not given, not applicable. That means what? What SR you have to take here? Not applicable. So what is your answer? 90,000. Higher of 1 and 2. So 90,000 will become your answer in first step. Now second one, standard rent is what? Not applicable. So expected rent is also what? Lower of 3 and 4. So 90,000. So actual rent received or receivable 72,000, that is given. So what is GAV? Higher of ARR or ER? Higher of ARR or ER? So here higher amount is ER. So what is your answer? 90,000. Once again I am explaining you. First of all, you have to write down fair rent. So fair rent is 80,000. Sorry, municipal valuation is 80,000. Fair rent is 90,000. So from these two amount, higher is 90,000. So that you have to take. Then you have to compare it with the standard rent. Standard rent is not applicable. So that 90,000 will become your ER. Now what is your ARR, actual rent received? That is directly given 72,000. Now from these two step you have to take higher value. So higher value is 90,000. So that is why your GAV is 90,000. In second house, municipal valuation is 55,000. Fair rent is 60,000. So which one is higher? 60,000. Now you have to compare with the SR, standard rent. So now from this you have to take lower amount, whichever is lower. So 60 and 75. Which one is lower? 60,000. Because your amount cannot be more than standard rent. So that is why here answer is 60,000. Because from these two you have to take lower amount, and from these two you have to take higher amount. So from these two higher amount is 60,000. So we have put 60,000 here, and from these two you have to take lower value. So that is why we have taken 60,000. Now again from these two you have to take higher value 60 and 72. So ER or ARR, whichever is higher. So here again higher is 72,000. So 72,000 will become your answer. Now next one, municipal valuation 65,000, fair rent 65,000. So obviously answer is 65,000. And now you have to compare with SR. You have to take lower amount, and lower amount is 58,000. So now 58,000 and 60,000. Whichever is higher. So again higher is 60,000. So that will become your answer 60,000. In house 4, 24,000 and 25,000. Higher amount is 25,000. So because higher of 1 and 2 you have to take. SR is not applicable, so that will become your answer. So your ER is 24,000 and your ARR, that is given in the example, 30,000, whichever is higher. So your ARR is your answer, 30,000. Now next one, 80,000 and 75,000. Which one is higher? 80,000. So now 80,000 and 78,000. Standard rent you have to compare it. So you have to take lower value. So 78,000. Here your ARR is 72,000 and ER is 78,000. Which one is higher? ER is higher. So that will become your answer. So these all things, very easy way you can find out gross annual value.